Hello, fellow traders. 'Tis I, the Rumpled One. It is July the 13th, the year 2020. Let's talk trading. Trading step by step. Step 5. Yes, I've already done one video here on Monday, July 13th, but I didn't want to leave you guys hanging. So we're going to get on to the step by step trading video. But these videos are for educational purposes only. Your results may differ from mine. Trading is extremely risky. You can lose all of your money. If you need trading, investment, or financial advice, seek the advice of an accredited financial professional. I've gotten a lot of positive feedback on this trading step-by-step series, but some people are wondering, it's like, well, you got to show us how to trade. You're not showing us any trades or anything. Well, it's like when you build a house, you have to do the foundation, then you put up the walls, and then you put up the wallpaper. You don't hang wallpaper until the walls are up. So, and you don't put the walls up till you have the foundation. So we pretty much laid the foundation, but there's one thing that we haven't talked about, and that is your trading plan. Because I've talked about being a trained monkey and how you're just supposed to follow the rules, but the thing about the trading plan and the thing about your trading is, as Deming would say, if you can't describe it as a process, then you don't know what you're doing. Now, that might seem harsh, sound harsh, might seem cruel, might seem rude, but the thing is, we're talking about the market. We're talking about people out there who want to take your money. It's ruthless. It's kill or be killed. So you need to have a recipe. And one of the things about a recipe is if it's a good recipe and you follow the instructions, your results should look like and taste like the person who made the recipe in the first place. So I'm sure you may have seen some of these cooking shows where, they teach you how to do it. And the thing about the recipe is it's step by step. They tell you methodically, you know, what the ingredients are, how much of each to use, the order to do it, the temperature of the oven, etc., etc. Everything's laid out as a process. So if your trading isn't laid out as a process, then you don't know what you're doing. It's that simple. And now, what are the components? Well, you have to be systematic and methodical. As I just laid out, let's like the recipe. You have to have a recipe for trading. Now, the thing about trading is it really needs to be data driven. So if you notice my systems, I don't just show you the system, but I show you the data behind it, meaning the statistics. This gives you the why this should work or why this will work. It also gives you the confidence knowing that you've got statistics, you've got history on your side. So if you enter a wick zone trade or a buy zone trade or a rat zone trade and you follow the rules, you're not going to win every time. But it's not about just one trade, it's about a week's worth of trade, a month's worth of trades, a year's worth of trades. And if you listen to some of these big time billionaire hedge fund guys, they might only put on, a handful of trades a year. They're not in here, grinding it out like us little scalpers, looking to make a few pips on a trade. No, it's a whole different ball game for them. But they have a systematic, methodical plan that's data driven. And the final piece to the puzzle is it's unbiased. Now, those of you who know me know about the rat and how the rat beat the Yale students. And so You've heard me say repeatedly, you want to minimize the number of variables. So you trade one pair, you trade one method, and you do it repeatedly. And it should work out for you. It's really simple that way. Where the problem comes is when you start to add a couple of methods. In fact, I'll even show you a screen where I've got 2 or 3 methods on there. But that's juggling. And as I've told you before, when you learn to juggle, you start with one ball, not 3 or more. And I've seen so many traders, they try to trade too many pairs. I said, trade one pair. What's so hard about just trading one pair? Focus. No, no. They'll have 17 different pairs, or they'll want the dashboard. And it's like, and can you add this to the dashboard? It's just, I just kind of shake my head wondering, it's like, what is it you're really trying to accomplish here? It's like you're going crazy. I mean, it doesn't make any sense to me. It just really doesn't. But I see people do it, traders do it repeatedly. But here's something that you really have to understand, and I heard it in a video. If what you're doing isn't a routine, it's rubbish. Once again, that sounds harsh, that sounds cruel, but it's something that you need to hear. Because if you're hopping systems like a butterfly, from flower to flower, or a bee from, you're buzzing around like a bee from flower to flower, you know you're not getting anywhere fast except in the hole. And if one time you're using one lot, and the next time you're using 10 lots, and then you're using 0.01 lots, you're just all over the place. You're not getting it. So once again, this step 5 is that you've got to have a plan, a system that has to be systematic and methodical, step by step. It needs to be data driven, and it needs to be unbiased. So as I mentioned before, people know I'm usually a green rat. I like to go long, and there's a few reasons for that. But the main reason I do it is usually like when I was trading dollar yen, it's because if I hold over, they pay me rather than me pay them. That's just something I don't like paying if I don't have to. Now, you've seen this chart before, very simple. And here we have it. We're right here. We've got a green H1. We're getting to the line. So what do? You go long. What's the plan? I enter here. Where do I put my stop? Well, maybe if I want to trade, I've got $1,000 account. I don't want to lose more than 1% or $10 per trade. So I go in here at one mini lot, $1 per pip. I put my stop right here. That's it. That's the plan. I'm trading this pair. I'm trading off of this chart, the 1-hour chart. I'm trading with the H1 candle color. And if it gets here, I'm going long. If it gets here, I'm going short. No questions asked. And I'm either going to win or I'm going to lose. Now, we've talked about that before in sense of we've got our risk in place. We know where the stop is. Then there's the money management side. And I know you guys have seen that screen before. Where is it here? Right here. The money management. You got to take the profit before the market takes it back. I mean, you can be up 10, 15, 20 pips, and if you haven't moved your stop, you could wind up getting stopped out. And as I was talking with Walmart today, I said, we really should just do this. We take 50% off the table when we have maybe 5 pips, move our stop to break even and let it ride. Or maybe we wait and see if it'll go to 10 pips, and then we take half off. But at some point, we take half off the table. That way, if it drops and hits our stop, hey, at least we got some. And if it takes off, hey, at least we got some. We didn't, miss out. So by taking half off, you kind of have a positive outcome no matter what happens. You can look at it from the positive standpoint, because what we usually do is we look at things from a negative standpoint, and we might get some of the rogo. Oh man, if I had only hold on. Well, if you do this, you're the one that's going to cause the pain, because it's your reaction to what the market did. And you just have to stop doing that. If you get 1 pip, if that's what your recipe, if that's what your plan says, it got to entry +5, move break even to or move the stop loss to break even +1, and it hits your break even, you did it correctly. There's no reason to have any of this, because if you don't, you're going to wind up with this one, the regret of being stupid. You don't want that. So you follow your plan. And as I mentioned in many videos, if you get stopped out at break even +1 10 times a day, you just made 10 pips. Now, it might not sound like much if you're only trading $1 pip, but if you're trading 10, that's $100. If it's a hobby, that's not bad hobby. If you're trying to put food on the table, then maybe you need to be trading a little bit heavier. So maybe you might want to do like the dragon, and maybe you might be trading, say, $5 a pip. That way, let's see, $10 a pip times 10 is 100. Maybe you might be trading $20 a pip, 200 a day. It's 1,000 a week. You're not buying a Ferrari, but that's not bad. Trading, maybe you're only trading 2 hours a day. So you have to work on math to see what makes sense to you when you get to the money management side of things. But you definitely want to take your pips when you can. So right here, see, we didn't trigger, and that's another thing. You have to follow your plan. If your plan says you get in at the 20 line, you don't get in at the 19 line. You get in at the 20 line. You don't get in at the 19.9 line. You get in at the 20 line. Because once again, it has to be a routine. If it's not a routine, it's rubbish. It's garbage. You want to minimize the variables, and you have to be the constant. You have to be the monkey that presses the lever and gets the banana. It's that simple. I know some people think I'm being funny, but it's only funny because it's true. You have to be that trained monkey, because many people say, well, you could just write an EA. Yeah, I can just write an EA. But even if I did, I wouldn't put it out to the public. And I've told you that before. There's too many things that can go wrong giving people EAs. Way too many things. All it takes is one mistype something, and we could be talking, hundreds or $1,000s of losses. So I don't give people those type of sharp tools that can really cut them up. The indicators, you can just watch them, but you make all the decisions. The computer's not going to be doing it for you. So today's main point is you really have to be systematic, methodical with your plan. It needs to come from data, not any back-tested curve-fitting garbage with a bunch of squiggly lines. No, we're talking highs, lows, opens, distance travel, ranges, etc. And finally, you need to be unbiased. In other words, in this particular instance, right now, you might think, oh, well, the market should be going up or the market should be going down. But if this says go short at the 10 line, you go short at the 10 line. You have no bias. Just a few minutes ago, you were looking to go long here. Now, that's opposite of you're being a Yale student in essence, but you're following your plan. If that's what your plan says, that's what you do. Because why would you do something else? You have to follow your plan. So, fellow traders, just remember, it's not what you trade, it's how you trade it. So drink